We have spent this whole series learning when and what to buy. But there's a far harder question, the one that quietly separates calm investors from anxious ones. When should you sell? Buying is driven by hope and excitement, which feels good. Selling is tangled up with fear and greed and regret, which feels awful. Today we untangle it, separating the bad reasons to sell, which are many, from the good ones, which are few. Let's start with the bad reasons, because avoiding them will protect you more than anything else. The first and most destructive is selling out of panic because the market or your stock dropped. We devoted a whole episode to this. A falling price alone is not a reason to sell. It is usually the worst possible moment to sell because you lock in a loss and miss the recovery. The second bad reason is selling out of boredom or impatience. A stock has gone sideways for a year, doing nothing, and you itch to do something, anything. But the market does not reward activity, it rewards patience. Selling a perfectly good investment just because it has been quiet is how you interrupt the very compounding you were waiting for. The third bad reason is the most seductive of all. Selling simply because you are up a little and want to lock in a gain. It feels so responsible, so safe. But if you sell every winter the moment it rises 10%, you guarantee you will never, ever capture the one investment that quietly multiplies 10 times over the years. You will have cut your flowers and kept your weeds, the exact opposite of what builds wealth. So if those are the traps, when should you actually sensibly sell? Here is the short, honest list. Good reason 1. The story has fundamentally broken. You bought the company or the fund for a specific reason, a thesis, and that reason is now genuinely gone. Not the price fell, but the underlying business has deteriorated, the leadership has collapsed, the product is obsolete. When the fact that made you buy have truly changed, selling is rational, not emotional. Good reason 2. You need the money for its actual purpose. This is not a failure. It is the entire point of investing. You're approaching retirement, or buying the house, or paying for the thing you were saving toward. Selling to fund the life you invested for is success, not surrender. The key is that it is planned, not panicked. Good reason 3, and this is the quiet workhorse. Rebalancing. Over time, your winners grow until they take up too large a slice of your portfolio, throwing off your intended balance. Periodically trimming what has grown too big and topping up what has shrunk keeps your risk where you want it. Notice this is a calm, mechanical sell, driven by your written plan, not by any headline or feeling. There is one more honest reason worth naming. A wildly better opportunity or an asset that has become absurdly, historically overvalued. But tread very carefully here because this is exactly where overconfidence whispers, and most people who think they're being shrewd are really just market timing and getting it wrong. For the vast majority, this reason should be used almost never. And do not forget the friction that makes selling costlier than it looks. In a regular account, selling a winner can trigger attacks on your gains, a real cost that buying and holding quietly avoids. Every unnecessary sale can hand a slice of your profit to taxes and fees. Sometimes the most profitable thing you can possibly do is absolutely nothing. Which brings us, of course, to the index investor's beautiful answer. If you simply own a broad index fund, almost all of these selling dilemmas evaporate. The thesis can never really break because you own the whole market, not a single fragile company. There is no individual story to go wrong. Your only real selling decisions become the calm ones, rebalancing occasionally, and eventually drawing the money out to live on. The agonizing question of when to sell mostly disappears. So look back at that hard question we started with. You now know the bad reasons to sell. Panic, boredom, and snatching a small gain are the ones that quietly destroy returns. And the good reasons, a broken thesis, a planned need for the money, and disciplined rebalancing, are calm, rare, and rational. Sell by plan, never by emotion, and remember that for most of us, masterful inactivity is the highest skill of all. I'll see you in the next one. Until then, keep it simple and learn the rare art of doing nothing.